So where the S&P goes now, let me just share with you some of my targets for the S&P 500. A lot of it depends on the earnings of the company, on corporate earnings. It's as simple as that, right? Remember, ultimately the value of the S&P, the price of stocks of companies are based on corporate earnings. Now, I think it's a foregone conclusion that there will be a global recession. I think it's like 98% probability global recession. So I think it's a given recession, right? But the question is it going to be a severe recession or is it going to be a mild recession? So my take is that I still believe that it will be a mild recession, specifically in the US market. Maybe in Europe it could be severe, I don't know, but in the US I still think it's going to be a mild recession. Let me just show you a couple of charts before I get into some target setting on the S&P. Now currently the S&P, as of yesterday, the PE ratio is 19 times earnings. Now, if you look at the last 10 years, the median PE was 26 times earnings. So again, we are one standard deviation below the 10-year average. And in fact, below the 20-year average as well. So relative in terms of PE, the market looks cheap. All right. Now, some people have said, but Adam, why don't you compare the PE to 1970s or 1920s? I'm going to do a video just on that itself. But let me just tell you that it doesn't make sense to compare the S&P 500 today to the 1970s or 80s or 1920s. To me, it's insane. You know why? Because the companies that make up the S&P 500 today are totally different from the companies that made up the S&P 500 in the 80s, 70s, or even 50s. For example, back in 1990, the biggest companies in the S&P 500 were oil companies, industrial companies, financial companies. There was no technology company. The only tech company was IBM. And at that time, it was more of hardware, not software. And there was no internet didn't exist at the time. All right. Or some of the biggest companies in the S&P in the past were airlines and all those stuff, right? But today, the majority of companies in the S&P 500 are technology-enabled companies like your Microsoft, your Alphabet, your Amazon, and your Tesla, and so on and so forth, right? So companies today, because they are technology-enabled, they are more scalable. They grow faster. They've got higher profit margins. Now think about it. Back in the 80s and 70s, how long did it take for a company to reach 50 million customers? It took like 30 years or something like that. I'm going to do a video just on this to give you the exact numbers, right? But in the past, for a company to reach 50 million or 100 million customers, it took 20 to 30 years. But today, a company like Disney, right, through Disney Plus, they can reach like 1 billion customers in 2 years because of the internet, because of globalization. So you can't compare, again, companies today to the past. It's insane. Companies today grow faster, higher profit margins, so they command a much higher price to earnings multiple than in the past. All right, so let me just say that, but again, I'm going to do a video just on this to explain why it is ridiculous. So anyway, I digress, okay? So PE ratio on the S&P now is 19 times. It is undervalued based on the last 10 to 20 years median PE. Now, a few other things I want to show you, which I think I did before. Now, people always think that if we go through a recession, earnings will fall, right? Corporate earnings will fall, correct. But people think that PE multiples will contract in a recession, wrong. In fact, I'm going to show you research that during past recessions and bear markets, when the earnings went down, price earnings multiples expanded. Yep, that's what a lot of people don't tell you. In fact, again, I showed you this chart before. During the great financial crisis, when corporate earnings collapsed, PE ratio expanded to 20 times earnings at the bottom. Same thing with the dot-com crash. Corporate earnings went down, PE expanded to 26 times earnings. Okay, now let me just show you some recent, well, not recent, but some recent research. Source is from DBS research, right? DBS research from which they got from Bloomberg. Okay, and let me show you something interesting. If you look at all the previous recessions going back to the 1980s, right? You can see the average recession lasted 11 months. During the average recession, corporate earnings fell 11%. But what happened to the PE multiple? It expanded by 7%. Interesting? So earnings go down, PE multiple expands. This is looking at all the recessions going back to the 1980s. Now, but like I said, some of these recessions were severe recessions. Like this was a severe recession. Corporate earnings dropped 42%. Corporate earnings dropped 17%. This was a mild recession. Corporate earnings dropped 2%. All right. So I think that even if we get into a recession, by the way, as of now, the US is not in a recession yet. If you take a look at the latest GDP now estimates, which is a real-time estimate, the estimate for GDP in quarter 3 is 2.7% expansion. So there's no recession yet, but it could be one in the next 1 or 2 years. All right. Now, so if we do get a recession in 2023, there are 2 reasons why I think it's going to be a mild recession. Right. First reason is because the US labor market is still very strong. Unemployment rate is still historically low. So when people have jobs, people have wages, they will still consume. And again, consumption makes up 70% of US GDP. So it will drive domestic consumption resilience in the US. First reason. Second reason is this. Household debt today in the US as a percentage of disposable income is at 101%, down from 134% during the financial crisis. In other words, in general, households are a lot less in debt as they were in the last Great Recession. They are financially stronger. And households' exposure to the property market has declined. In the financial crisis, households had a debt servicing ratio of 7.2%, which means on average 7% of their income went to paying interest on their mortgages. But today it's only 3.9%. So in general, people have less exposure to property versus the financial crisis. So in other words, even if property prices go down, even if we get a recession, companies and individuals are a lot stronger than in past crises. So with that, they can continue to consume, and there should be resilience in corporate earnings. All right. So if it's a mild recession, let's take a look at the last 4 mild recessions in the US. On average, you can see earnings contracted 6%. Earnings fell 6%, but PE ratio multiples expanded 6.6%. That offset the fall in earnings. Interesting? I thought it was really interesting. So credit source to DBS research. Now, so based on that, I've computed my worst case scenario and best case scenario for the S&P 500 for next year. All right. Now, I did something using the intrinsic value calculator by the professor at NYU in my last video. So I'm using another approach right here, using the PE approach, and I'll see whether I get a similar number, right? Okay, so let's look at a worst case scenario. Worst case scenario, right? So analysts, they have been lowering their earnings projections. So for 2022 this year, for the full year, they are projecting $223 earnings per share expected by the end of the year. Now, Yardeni Research is a bit more conservative. They are projecting $215 earnings per share this year. Okay, so what is my projection for earnings next year? Again, what's the worst case scenario? The worst case scenario would be a 17.5% contraction in corporate earnings. That is the worst in all the past mild recessions, and that happened during the dot-com crash. Okay, so let's use 17.5% earnings contraction. So if you take $215 earnings per share and contract it by 17.5%, you get 177.38 earnings per share. So this will be the earnings per share for 2023, for the year 2023. Next, we have to take the earnings per share and multiply it by the PE multiple. So what PE multiple do we use? So again, the current PE multiple is 19 times earnings. But like we saw, what happened during recessions, when the earnings dropped by 17%, PE multiple increased by 11.4%. So we have to increase the PE multiple based on what we've seen in the past, right? So if you take 19.16 increased by 11.4%, that gives us a PE of 21 times earnings, which is not that far off, because you can see that again in previous bear market bottoms, the PE was 26 times. PE was about 20, almost 21 times. So it's not unreasonable to take a PE of 21 times earnings, right? So you take 177 times 21 gives us a S&P target of 3785. 3785. So where is that on the chart? So if you take a look at the charts, you can see 3785 would be here, this green line, which is where we are right now. So in other words, like I said, I'm not surprised that even if we go into a recession and corporate earnings drop 17% based on the S&P multiple, this is the fair price. In other words, this could be the bottom. This could actually be the bottom, right? Now, but what if we are even more conservative? We say, you know what, let's not increase the PE multiple. Let's just take 19 times as the PE multiple. So if you take 19 times, multiply by 177, you will get about 3004, which is this target over here. Okay, so to me, based on this calculation, my fair value for the S&P in the event of a recession would be within this range. So in other words, I don't see that much more downside to the S&P 500. Okay, now again, anything could happen, right? If Putin starts a nuclear war, okay, then sure, we could crash 50%, but I can't control that because I don't know Putin, all right? But I'm assuming that everything stays where it is right now. That's our downside, okay? Now, some people have said, but Adam, how about this Credit Suisse situation? Hey, that's been blown out of proportion. Yes, Credit Suisse has not been doing well for many, many years. They have been plagued by scandals, but they are not anywhere near liquidation. Credit Suisse, their CET1 ratio, which is their common equity tier 1 ratio, which is the measure of the bank's financial stability, is at 13.5%. 13.5% CET1 ratio, which is above JP Morgan. JP Morgan, I think, is about 12% right now. So Credit Suisse, in terms of financial strength, is actually stronger than JP Morgan because the Swiss bank is even more conservative than the US central banks. By the way, during the financial crisis, when Lehman collapsed, most of the banks, their CET ratio was 5% at that time. So now it's like 12, 13%. Banks are much stronger than in the past. So no worries about that, in my opinion, right? Okay, so that's the worst case scenario. Now, what's the best case scenario? The best case scenario is that companies meet their earnings projections, which analysts now project after some cuts. They project it to be 241.83 for 2023. So that's the earnings per share for 2023. So if you take 241.83, multiply by 26 times earnings. You say, why 26 times earnings? Because, well, sorry, before that, let's not even take 26 times earnings. Let's take 19 times earnings, which is the multiple today. You multiply that, you get 4627. So that's the best case scenario, right? So the best case scenario is 4627 would be here. Ta-da! Which means by the end of next year, we should be up here on the S&P 500, assuming PE doesn't expand. All right. Now, if there's a PE expansion, which means PE expands from 19 times back to 26 times. Why 26 times? Because that's the 10-year average. If it expands to 26 times, hold on to your hat. If you take 241.83 times 26, you get 6287 on the S&P 500. Where's 6287? It is all the way up here. In other words, in the super best case scenario, hallelujah, the S&P could be at 6287 by the end of next year. Now, some of you are thinking, Adam, you're on drugs. Maybe. But drugs are cool. By the way, in Singapore, if you take drugs, they hang your ass. So my only drug is knowledge and optimism, right? And you never know. So again, in summary, this has been a long video, I know, but in summary, remember this, that anything can happen in the markets. You know, we can all do our forecasts, but you can't predict the future. You know, if Putin, launches a nuclear weapon, if, some other shit, you can't predict, right? So the most important thing that I tell my students is this: our investment decisions are purely based on investing in the best companies in the world that have got low debt, high free cash flow, dominant position, and we just slowly buy in. As long as they're undervalued, we're going to do really well over time. And for short-term trading, I may do more videos on short-term trading. If you're interested, let me know. I'll do more on short-term trading where I use a lot of options where I just trade according to the trend. So there's a clear uptrend, I go long. There's a downtrend, I go short. Or I may also trade reversals when stocks are way oversold or overbought. So if you're interested, let me know in the comment section. I'll do more videos on short-term swing trading if you're interested. But I thought that this would be a video to give you some perspective of where we are in the markets and where we can move towards. Take care, guys. May the markets be with you. If you want to catch my latest videos, click on the subscribe button right now. Click on the bell so you get instant notifications once I upload my latest video. If you want to check out my online courses, go to piranhaprofits.com. We're going to learn how to invest and how to trade the financial markets and create an income from all around the world. If you want to join my live Wealth Academy program, go on to wealthacademyglobal.com and find out more about how you can learn investing and trading live online. This is Adam Khoo, and may the markets be with you.